When we hit critical mass of $5 to $10 billion, that's when the big players, right? Your Fidelity asset manager types start to go, oh, wow, there is actually a market here and one that we probably need to be plugging into. And that's the world that I ultimately see. We talk about alts going mainstream. In the next decade, I see a world where folks are investing in startups, they're investing in real estate, they're investing in high-end collectibles and artwork and all of these things. They're investing in debt products, whether that's consumer debt or commercial debt. All of these things are in their portfolio, a part of the kind of new portfolio construction that's no longer 60-40 bonds, right? We have all these other things in there, whether it's through fund products or direct investments, and they're doing it directly out of their brokerage accounts.
Ladies and gentlemen, welcome back to another episode of Next Big Thing HQ, where we interview founders and showcase startups that are raising capital via Reg CF. Today, we have an amazing guest, Chris Lustrino. Chris, thank you for joining us.
Really glad to be here, Connor. Thanks for having me.
For those of you that don't know, Chris is the CEO and founder of KingsCrowd. KingsCrowd is the first data analytics platform for private markets that are raising capital via equity crowdfunding. So, Chris, I feel like that description of KingsCrowd really doesn't do it justice. So why don't you really tell us what KingsCrowd is and all the different avenues that KingsCrowd serves in the equity crowdfunding industry?
Absolutely. Really, really simply, right? If you are an investor and you use Robinhood or you use SoFi or any of the brokerage accounts, right? If you have an investment account today and you're investing in public companies like Google and Facebook and Meta, so on and so forth, it's very likely that before you go and click on invest in your brokerage account, that you're going and using some sort of investment research service. You may have heard of Morningstar, you may have heard of Bloomberg, you may have heard of Seeking Alpha. You might just Google around and find whatever reports you can on the company, but you're doing some sort of research, right? There is a plethora of data companies and research companies that are going to help you make informed decisions when it comes to investing in public equity companies. Now, when the Jobs Act came about and it became available to everyone to be able to invest in private companies very much in the same way as public companies, that's where our opportunity arose. So really, our goal at KingsCrowd is to build those Morningstar, Bloomberg, Seeking Alpha type data and investment research resources, but specifically focus on the regulation crowdfunding, regulation A+ markets where private companies are publicly listing and enabling anyone to invest. We want to help you make smart, informed investment decisions in this new investment landscape.
So then the question is, with public companies, they have to file, 10Qs, 10Ks, so that's where you get all the data. But how do you get data for these private markets on these startups that aren't filing necessarily, quarterly updates with the SEC?
One of the major drivers and reasons why I went ahead and started to build this business was because of the opportunity this brand new market presented on the data front. I actually come from the traditional private equity world where we would struggle mightily to get any sort of good or accurate data on private companies. Why? Because traditionally, one of the reasons why you stay private is so that you don't have to share any of your information publicly. But in order to do a regulation crowdfunding or regulation A+ raise, in order to raise from the general public from thousands and thousands of individual investors, what the SEC requires in exchange for giving you access to that retail investor base is a requirement that you file certain information with the SEC that is publicly available. So every company that raises capital online under Reg CF and Reg A+ has to file all the terms of their deal. They have to file how much they're looking to raise. They have to file what they're going to do with those dollars. They have to file 2 years of reviewed or audited financials created by a CPA in GAAP financial format. This is the type of data that we've never had on private companies. In KingsCrowd's database today, we have 7,000 private companies that over the past 6 years have raised capital under Reg CF and Reg A+. And we have real financials, real terms, real success data, and follow-on data from many of those companies. So what we have is this kind of unprecedented transparency in private companies that we've never had before. And now we're consolidating all of that information in one place and tracking the performance of those businesses over time so we could start to understand the dynamics of private market companies.
And with this data, it's helping you fulfill the mission of KingsCrowd, which is to democratize startup investing for all. So at what point in your career did you kind of flip the switch from, working as a consultant to saying, you know what, I want to do this. I want to go on this mission to democratizing investing in startups. What was the genesis of KingsCrowd?
I didn't even know what being a founder was when I left school in 2014. And I was working as a consultant. And one of the reasons I went and became a consultant was because I thought, if I work at the very highest level, right, the people who typically hire consultants are the C-level executives.
Yep.
So if we're working on their problems, that's an opportunity to affect real change. And I knew that no matter what I did in my job, I wanted to be in a position to affect real change. And then I realized as a consultant that you don't have the final say in what decisions are actually made based on your findings. And I basically realized as a consultant, you're completely powerless and actually have no role in the ultimate decisions that are made by an executive. And that drove me kind of crazy. But more importantly, it was really during that time where I was living and breathing private equity. We were working on behalf of many private equity firms doing all of their due diligence on the potential investments they were going to make. And there was things about that process that just drove me absolutely nuts. One of them would be the fact that the data in the private markets is so horrendously bad, right? We would work on behalf of these billion-dollar companies that were selling to private equity, and it was impossible to get their financials out of them. It was impossible to get any sort of market data. We were talking about like very, very key data points that are needed to make billion-dollar decisions, and we had no access to that data. And it made our job so incredibly difficult. And I thought there has to be a better way to be making these investment decisions. And then the other thing, and I've talked about this a lot, but I was sitting there and I'd spend anywhere between 100 to almost 400 hours diligencing any given deal and realizing, oh, wait a second. I don't have any way of actually accessing and investing in that deal, right? It's a private deal. I can't invest in it unless I'm working at that private equity firm. And that was the other thing that really bothered me. So that was the genesis to Google, why can't I invest in the private markets, and learned about this whole new world that was emerging that from my perspective was solving the transparency issue. Hey, you can access deal flow, but in exchange, you're going to have to share data. And that was really exciting to me. I ended up starting a blog on that in 2015, 2016, and ran that for a few years. And I talked to every founder and CEO that was building in this market. Think Republic, WeFunder, so on and so forth. And having those conversations with so many of those founders, it became more and more apparent to me like, oh my God, I am in the wrong place. I have to go and become a founder. I have to be the one who could actually take action to affect how the world will look in the future. And in 2018, I got a call from one of the founders of Napster from way, way back in the day, if you remember that, and said, hey, you want to take your moonlighting project and build it into a real business? And that was the impetus to say like, okay, this is the right moment in time to get after this opportunity.
Now, when you first started, you said you had no idea what being a founder was like in 2014. So kind of looking back at the journey now, would you do it all over again?
There's not a doubt in my mind that I would do it again. And I'm pretty confident that I can never, ever do anything else. That being said, I would argue that it's absolutely the hardest and at times most painful process you can go through. It's not for the faint of heart. And there's so much about it that has been just like painstaking. But at the same time, despite all of the pain that's been involved with it, I find myself still wanting to do this job every day.
It seems like it's a common theme that it's the most painful thing you can go through just because of all the constraints, challenges. You know, it's never a smooth sailing. But at the same time, there's so much reward and so much fulfillment that you get going on this journey.
1000%. The only thing I just want to reiterate is like, when you hear, oh, but there's nothing else I would do in this world, right? That kind of gives you that's that sugar-coated moment where you go like, yeah, I see, that's why I got to become a founder. But I really want to stress, like, in any given day, you know, you could have legal issues, you could have financing issues, you could have sales issues, you could have team member issues, and then you could have the greatest highs of finding out you have great financing, working through your legal problem, working through your employee issue. And those could all be amazing, but it's like every day you could be facing something for years and years and years on end. So just recognize like there's going to be a lot of down moments and painful moments, and that's just inevitably a part of it. And I think part of that pain is what creates the joy of doing it when you have those great moments, because they're so earned and you know how hard it can be. So I just want to reiterate that, like, there truly is a lot of pain involved. And don't think because we say it's the greatest job in the world that it necessarily feels like that in any given moment of any day.
It's kind of like a paradox. It's quite ironic thinking about it. But looking at KingsCrowd, all right, so KingsCrowd grows from when you found it to now. How many employees work at KingsCrowd?
Yep. So today we have, I want to say just about 13 people between kind of our two divisions in total.
Okay. And then the two divisions, you have, it looks like the data aspect, right? Kind of managing the platform. But then you also have KingsCrowd Capital Fund. So is that a separate branch that you're developing on KingsCrowd, launching Fund 1? And then if so, can you talk more about what Fund 1 is going to look like?
Absolutely. So we actually have kind of, you could say, three business units, but I kind of think of them in two distinct buckets. So we have KingsCrowd, as you mentioned, which is the data business that powers everything. Then we have KingsCrowd Capital. So KingsCrowd Capital, essentially the idea here is that as more alternative investments become available online, right, via WeFunder, Start Engine, Republic, when we're talking about startups, might be Fundrise and Ground Floor. When we talk about real estate, might be Rally Road and some of the other collectible platforms. When we talk about collectibles, as more and more of these private market assets become digitally native, meaning anyone can go and create an account and invest in these opportunities, the opportunity we see is to collect the data and information available on those opportunities, develop automated investment research mechanisms to evaluate those opportunities, and then essentially create fully programmatic, almost AI-driven index-like fund products for those asset classes. So we're proving this model by creating KingsCrowd Capital Fund 1 that we launched about a year and a half ago, and we've been investing out of that fund ever since. So we raised about a $1.7 million fund. The goal, right, not that it's happened yet, but the goal is to show that we can outperform the broader market by using the KingsCrowd rating algorithm to identify the investment opportunities to invest in. And then we're investing in 100 of those businesses over 4 years to see if we could outperform the market with this index fund-like approach. So that's KingsCrowd Capital. The long-term vision there is that we can launch a multitude of themed funds, right? So think about an ESG fund, a female founder fund, a clean tech fund, a really good value fund, right? Where maybe we're only looking at profitable private businesses, whatever it may be. And then over time, add other asset classes as well. So that's the idea there, is create one-click diversification to any theme and asset class that you can think of over the next decade. Now, our other division is called Raise Papers. Raise Papers is our founder division. And essentially, we realize that our data can answer a lot of the questions that founders have before they go to raise capital online. So the questions that founders have come to us with over the years have been, how much money can I raise? Where should I list? What should my valuation be? What should my terms look like? What type of security should I use? How do I form my security? How do I form my filings? And so Raise Papers is really a software-based business that utilizes KingsCrowd's data to power all sorts of unique solutions to help founders get ready to raise capital online and manage all of those processes.
That's fascinating. And I remember seeing, I think it was a tweet that said, you're noticing on KingsCrowd, you're getting a lot of founders starting to sign up and create an account because they want to see the data, because they want to know what they're getting into before they start a round, and also how to kind of position themselves well so that they can have a very successful round, which is, really fascinating. A lot of times you just think about the investor's perspective, but it is a marketplace, right? You got to think about both sides. You got to think about the founder and the investor. And it seems like you're doing a great job thinking about both. So that's awesome. I completely forgot about, the founder's perspective too. So what do you tell the founder when they say, how should we evaluate our startup? Is there like certain metrics you look at that you can kind of talk to us and, tell us more about?
Great question. And I'm happy to share a link with you after this episode, but we created something called the Founder Valuation and Market Comps tool. Long name, but very valuable service. And essentially what it does is it allows a founder to enter, when they founded their company, how much money they've raised prior, what industry they're in, what stage of company they are, if they're generating revenue, how much, are they profitable? They could talk about how much money they're looking to raise, what their past backers look like, so on and so forth. And then once they put in how much they're looking to raise, they basically click, run report, and we'll actually pull up all of the market comps from the last couple of years and be able to tell them, here's the valuation ranges, here's the revenue multiple ranges, here's how much you can expect to raise ranges, here's, all the kind of scatter plots and data points, top market comps. And then we'll also be able to tell you top 5 platforms in terms of number of deal flow of food and bev companies that look like you, and dollars raised and number of deals. And we could break down all of that information for you and then provide consult services around that and even introduce you to the platforms off of it.
That sounds extremely helpful. And I think especially too with the comps, that gives them a range, not necessarily an answer. And that's probably what most founders want, right? They want to pick a range. That way they can decide the answer instead of just being told, this is the answer, right? They want to kind of figure out the reasons why the answer is the answer.
And one of the other things that we have found is that a lot of platforms struggle when founders want to overprice themselves. And they say, you're overpriced. And they're like, to what? This is what we think we're worth. And to be able to quite literally say, well, here's all the comps,
Right?
here's how they performed, you take your pick, but the data says otherwise. So it really gives them something very concrete to go off of, which I think is really, really valuable. And one of the market inefficiencies I see in traditional venture capital is by companies not sharing what their underlying financials look like, right? Valuations get really out of whack because no one really knows what the revenue multiples look like or anything like that. So there's a real market inefficiency there. And with having real financial data tied to valuations, we now have a mechanism to transparently display what the valuation range really should be.
That's fascinating. And then what type of other metrics do you show if someone were to create an account on KingsCrowd? What would be, I guess, walk us through kind of the overall platform from creating an account to then wanting to make an investment? What are you going to be able to see in order to make the best possible investment?
So what we tell folks when they come to KingsCrowd is we really help with three key things. That's search, diligence, and management. So on the search front, right, on any given day, there's anywhere between 500 and 800 individual startup investments across over 90 marketplaces and even their own websites. So all of that is to say, this is a very unwieldy world that's very hard to navigate. You can come to KingsCrowd and you could use our Deal Explorer and say, I just want to see companies that are worth less than $20 million, that are generating $1 million in revenue, that are in financial services and are female founded, whatever it is you care about. And you could suddenly go from 800 deals on 90 platforms to 3 deals that fit your criteria. And then once you've done your search and you kind of get to, okay, my thesis has led me to 3 that are worth spending time with, you could click through to each opportunity and evaluate them on some key dimensions. So a lot of the key things investors want to look at, right? Price. So tell me what their valuation is. How does that compare to the market? How do they score on their overall valuation? Are they underpriced? Are they overpriced? Is it good value? Is it a bad value? They want to look at the team. How experienced is the team? How deep is the network of the team? Do they have access to capital? They want to look at the performance of the business. How much capital have they raised to date? What have they been able to accomplish with that? Is that more accomplishment versus companies that have raised money or less accomplishment? What is their actual performance in terms of revenue and revenue multiples look like and their burn rate? So what does their financial position look like? And we're also going to look at, how differentiated are they in the market? Are there other competitors and incumbents already out there? Or is this something that is truly uniquely differentiated and entering the market as a wholly new solution? So we're essentially giving you this really nice data-driven evaluation from end to end of tell me if the deal is good on the deal terms to is this the right team to is this the right product service offering? So that's what you're going to get. And then you'll have an analyst report as well for many of those businesses. We actually utilize artificial intelligence to help us generate those analyst reports and be able to do a greater quantity of analyst reports. And we'll do a deep dive on those businesses. You'll also have the ability, if you want, you could actually track our strategy at KingsCrowd Capital. So every time we make an investment out of the KingsCrowd Capital fund, we rate it a top deal and provide a fully deep dive analyst report, founder profile, and podcast with the founder. So you have a full package of diligence materials to understand why we invested in a certain deal. And then that last part that I mentioned is managing your portfolio. So you could imagine as you add investments to your portfolio, it can get unwieldy because right now, there is no one place to make all your investments, right? You'll have an account on Republic, you'll have one on WeFunder, you'll have one on Start Engine, so on and so forth. We provide a one-stop shop to be able to track all of your investments in one place. You input your data, when you invested, how much you invested, and we take care of everything else for you. We give you analytical breakdowns of your portfolio and are even working on a lot of tools to provide more exits and updates data so you can understand the overall value of your portfolio and performance.
Then you mentioned the KingsCrowd Capital Fund and the investments you make. You're going to write a deep report and then have the founder on the podcast. And I believe the podcast is Inside Startup Investing.
That's right. Yep.
So can you walk through your allocation of capital within the Capital Fund 1? Because when I was looking it up, I saw 30% for seed stage and then 40% for early stage and then 30% reserved to double down on the Windies. So first off, why 30% versus 40% for seed stage versus early stage? Can you just, walk us through kind of your thought process on distributing the capital that way?
Yep. So essentially at the end of the day, when we were developing the fund, we were looking at a multitude of strategies to create basically the best kind of risk reward diversified fund product that we could. And it's just, when you're looking at early stage companies, yes, you have greater upside, but you're also taking on greater risk. So we're trying to create a really nice blend of how much risk we're taking versus how much reward we're looking to get. and blend that in the right way. So after looking at a whole bunch of research and doing our own analyses of our deals, we felt like that was a really good blend. And listen, those are on the margins, whether you change those to 35, 40, whatever, probably not going to make a major difference. But the general, idea of kind of creating those right allocation buckets and having, 30, 30, 30-ish, that's where we kind of wanted to come out, and doubling down on those winners always makes sense because, the winners are really where you're going to see some of your upside. At the same time, I think one of the very unique things about our fund is that by investing in 100 companies across kind of this entire spectrum, we have an opportunity to take different types of investments into the fund. So for instance, yes, we want to take those kind of, traditional venture theses investments where they're worth 5 million today and we think they could be worth $1 billion someday, right? And more than return an entire fund. That's exciting. But we also can take the company that's doing 25 million in revenue and has $1.5 million in net income and is worth 30, 40 million dollars that a venture capitalist actually won't be interested in, and say, hey, we think this could turn into a 75 to $100 million revenue business worth $200 million. And in that world, we're going to make a 4 or 5x, and our risk is almost zero because they're a profitable, high growth company. So we get to take kind of this blended strategy of your traditional venture investments, as well as more of your private equity style, well-established, well-growing, even profitable businesses, and get a nice spectrum of singles, doubles, and triples in addition to the home runs.
And so what would define success for this capital fund?
I think from my perspective, at the end of the day, can we outperform the broader market? So if you were to just kind of go and, maybe take the old spray and pray method, right? Of just kind of investing in whatever deal that you get excited about, having 10 to 20 companies in your portfolio, can we beat that strategy? And by an order of magnitude, right? Can we really improve on it? I think that would be an exceptional result. And if we could show that we're really good money managers at the end of the day, right? Even if it's not the most unbelievable return, but maybe we 3 or 4x the fund. If we could do something like that, what it signals to the market is, oh, wow, there is real opportunity to be had in this space, and more people should be working in this space and building fund products in this space. At the end of the day, I don't expect to be the only capital, fund allocator in this market. I really want other people to come into the space and build fund products and license our data to build funds of their own. That's a perfect world for us, and that's the world we want to see. Anyone who could bring more diversification products to this space and start to deliver them through RIA channels and wealth advisory channels and family offices and provide that one-click diversification, I think is going to be really, really powerful and a major catalyst for our market. So what we want to show is this is a real and viable path, and that there's real results and returns to be had.
And the amazing thing too is, even if you beat the S&P 500, right? So you don't have to hit venture returns, but you beat the S&P 500. Since this is equity crowdfunding, anyone can participate, which means anyone has the opportunity to now invest in equity crowdfunding in your future funds instead of investing in the market, in the public markets. And I find that so fascinating. This is a great way to validate the equity crowdfunding market and really prove that, it's here to stay. The returns are good, and that more people should know about this market and invest in this market.
And one of the challenges that the overall market faces, right, and any new market will struggle with this, is allocation of investments into these deals in an efficient manner, right? A lot of companies who come on these platforms are either ill-informed or don't come with the right strategy, and they do struggle to raise capital. And sometimes, unfortunately, the deals that get funded the most are far and away not the best deals. They're just the ones who have the deepest pockets to spend a lot on marketing and different initiatives to drive investment into their deal. What we want to help do is create efficient capital allocation in the market. So we want to help people identify what are truly fundamentally sound businesses that they should be investing in, help them find them efficiently, allocate dollars to them, and have our own fund and other funds investing dollars into the best deals in the market in a really efficient way, so that we don't end up with a bunch of companies who just had deep pockets, who aren't that great, who are raising a bunch of money and not having strong performance. We want people to get great performance and have dollars get to the deals that they need to get to. So for me, the question we're always asking ourselves is, how do we make this market more efficient? The capital fund product is just another way of getting after that initiative.
And it seems like it always comes back to information, the more information that these investors can have, but also consumable information, right? Something where investors can kind of get the big picture and really understand what the company looks like without having to spend like 3 weeks researching the company, doing deep dives, doing a great job providing industry reports, deep dives on those companies so that people don't have to do their own research, having them on the podcast, showing the metrics. So I think that's really exciting. But you started 2018 and now it's 2024. So talk to us about how you've seen the market grow, how you've seen it change, and what you're excited for in the future.
Well, when I started this business in 2018, and don't quote me on these numbers, but I would say there was probably somewhere between 50 and 150 companies that raised capital via Reg CF and A+ in that year. Sub $100 million, really small, right? No one cared at all. Last year alone, we had well over 2,000 companies raise under Reg CF. Reg A+, you had hundreds more companies and collectively raised over $1 billion under Reg A+ and Reg CF in just equity deals alone. What that says to me is there is this kind of compounding growth effect that's occurring. A lot of people still don't realize how big the market opportunity here is because we're still in the very, very early days.
Mm-hmm.
Just think of the number of barriers that this industry is having to go through, right? You have traditional venture capital that says the only way to raise money and be successful is to raise with us. So you have founders hearing that. They've also never even heard of the space. So the idea of getting them to go, I'm going to kind of pseudo publicly list. I'm going to share more information around my business. I'm going to take on a capital raising strategy that maybe isn't all that well accepted by the traditional investing community. Do I want to do any of those things? And while a lot of that information is wrong, right, it takes time for other founders to succeed in going to market, successfully raising capital, having good experiences, going on to raise from institutional investors and saying, oh, this is a real and viable path. There is a way to be successful here. And then for investors who are sitting on the sidelines, looking at this space and going, I hardly know how to invest in stocks. How in the heck am I going to be able to invest in startups? Or maybe they make a few startup investments in this market and they get burned, right? Because they get psyched and hyped in the marketing videos or whatever. And then they're left with no returns and they go, wait a second, maybe this isn't for me. So all of that is to say is when you open up a new asset class, and in this case, we're talking about startups, it's really, really hard to change investor behavior. It's really, really hard to change founder behavior. And it's really, really hard to make the incumbents, in this case, the venture capitalists, comfortable with this new market emerging around them. So there have been so many incredibly challenging things for us as an industry to maneuver. It has not been an easy road. And I would say that while all of us probably hope we'd be in the, third or fourth inning of a 9-inning game by now, right? We're probably still in batting practice, getting ready for the game to start. Like really, we're still so in the early days of this industry. I think when we hit, a critical mass of $5 to $10 billion, that's when the big players, right? Your Fidelity asset manager types start to go, oh, wow, there is actually a market here and one that we probably need to be plugging into. And that's the world that I ultimately see. We talk about alts going mainstream. In the next decade, I see a world where folks are investing in startups, they're investing in real estate, they're investing in, high-end collectibles and artwork and all of these things. They're investing in debt products, whether that's consumer debt or commercial debt. All of these things are in their portfolio, a part of the kind of new portfolio construction that's no longer 60-40 bonds, right? We have all these other things in there, whether it's through fund products or direct investments, and they're doing it directly out of their brokerage accounts and they're thinking nothing of it. That's the world I think we're going to get to. That's the world we want to serve, but you kind of have to take baby steps to get there.
And if we look at what's holding the industry back from getting to that $5 billion, from getting to that $10 billion mark, it seems like a big thing right now is liquidity, right? There hasn't been many IPOs within the equity crowdfunding market. And I think that's one issue. The IPO market has also been pretty cool lately. It should heat up. It sounds like it's going to heat up in 2024. So that's exciting news. But then another thing too is secondary markets. And it seems like StartEngine and WeFunder are starting to come out with these secondary markets that will help increase liquidity. So what do you think are the limiting factors that is holding the market back from hitting that 5 billion to 10 billion, or maybe taking it a little bit longer to hit those marks?
I actually think it's a couple of really, really simple items. And yes, liquidity is super important, right? The ability to buy and sell into and out of these things is going to create a lot more velocity in the market and a lot more investment. If I could get out of some of my startup positions today and reinvest it in new positions, I'd be psyched about that. And it would definitely lead to more investment in the market. So don't get me wrong, that's important. But I think at a really basic level, this is an awareness and education problem. And that might seem super simple, but it's really interesting. I think for any true shift to occur, especially in financial services, you're talking about anywhere between 10 to 20 plus years for that entire shift to actually occur, right? Mobile banking started in the early 2000s. It's only now that mobile banking is kind of the predominant form of banking. It's taken about 25 years to be fully adopted. And part of that is just a generational shift. So when I talk to college students today, more of them know about Republic and WeFunder and Start Engine, so on and so forth, than anyone in their 30s or 40s that I talk to. So I think, as those folks come up and they want this as part of their investment strategy and they're aware and educated and knowledgeable about all of these different types of things, then it just becomes a part of kind of the ecosystem of investing. And as that happens, right, and they put pressure on the system from the Fidelities and the TD Ameritrades and the SoFis to offer alternative investments, then the distribution channel turns on to the wide world of massive assets. And that's the crux that really turns this thing into a huge market. But at the really, really basic level, it's a time game and it's getting more education awareness in the market to have enough velocity of investors partaking in the market to make it significant enough to then have the institution step up to get involved.
And to kind of go off that point, I told my friends I was investing in the startup and my family, they all joined in the investment too. So they were all more than willing to invest. They just didn't know that they could invest. It's like what you said, it's just the awareness is holding them back because everyone likes to invest in a startup. They find it exciting. It's an interesting story. Oh, it could be, there's always the potential. It could be the next Uber, right? That's always said a lot. I think there's something special seeing a startup go from a startup to then a company and watching the growth over time and knowing that you are one of the early believers when it was, not probable to be successful, but you like the company, you like the mission, you like the founder. So there really is something special about that.
You're absolutely right. And you mentioned one other thing that I do think is really important as part of the education awareness cycle. One of those things that's going to help drive the market forward on that front is success, right? Mm-hmm. However we want to talk about startup success, I think everyone early in this market was trying to say like, well, you're going to have to wait 3 to 5 years. 3 to 5 years is a pipe dream, right? You're talking about more like 8 to 15 years to see true success and have those exceptional IPOs, massive companies built, going public, having major acquisitions, becoming worth hundreds of millions or billions of dollars. It takes time. And it takes far more time than I think any of us are willing to admit. When you have some of those stories come out, that will really excite investors. Ironically, I would argue, and I kind of believe, that some of the best deals that will ever be had in our industry are occurring right now when people think very little of our industry, right? They think the deal flow, I'm not so sure about it. And that's because no one's looking. But when no one's looking, prices are lower. Startups are having to be more savvy about how they raise capital in this market. So there's actually some incredible deals. I have a feeling that when those amazing stories are told, there's going to be a whole swath of companies that are kind of mediocre that come out and raise a lot of money because people are hoping they could get in on the types of returns that folks were seeing from 10, 12 years ago in these first vintages. So again, going to the time game, it's going to take many years for us to see those successes that really get people drawn in and say, oh, wow, there's an opportunity here.
So it seems like you're seeing a lot of really good deals in the market right now. You don't have to talk about the deals, but is there a common theme, a common thread that you see among the deals, maybe a couple common metrics that you can kind of tell us that this is what you look for when investing in a good deal? This is kind of a really good green flag of a good deal.
What I love is that I am seeing more and more deals that don't fit the traditional venture model. But I want to be really clear about something around the venture ecosystem. The biggest issue that I have with traditional venture capital is that the entire venture capital ecosystem essentially has one thesis. We're looking for billion-dollar plus companies that are in multi-billion-dollar or trillion-dollar markets. And here's the reality. There is probably going to be 100 to 300 billion-dollar plus companies that are built over the next 8 to 10 years. These venture capitalists are going to deploy money into 40 or 50,000 startups in that time and have about 40 to 50,000 of them fail to find those handful of investments. But the really interesting reality is that during that time, there's probably going to be 10,000, 100 to $500 million businesses built that can lead to incredible returns for investors, especially if they're correctly priced at the beginning. And so what I see in the market is companies that have recognized that right now, today, with the venture capital ecosystem, there's only one fuel to grow your company, and it's venture capital. So the way you have to pitch your business is, we're going to be a multi-billion-dollar company. But I'm seeing companies who are recognizing, I finally don't have to just go for this one type of fuel that exists. There's another type of fuel. So I'm seeing companies that are generating 5, 10, 20, $30 million in revenue, growing 20, 30, 40, 60%, but they still don't fit the profile for these venture investors because they're too established. They have too much success to potentially be $1 billion company. You could probably only be a 3 or 4 or $500 million business, which is insane. So you're essentially seeing this opportunity to invest in a much more interesting distribution of types of companies. Of course, we see the venture backable companies coming and saying, we're building the next AI thing that could be worth $1 billion. But we're also seeing this whole swath of companies that are saying, we're more of a private equity style deal. You're getting it at a $30 million valuation. We have the opportunity to grow to be a $300 million company. That's a 10X for you. And by the way, we're not going anywhere because we're profitable. Those types of companies are so interesting. And that's honestly where probably most people are going to make their returns. And as an individual investor, you could do quite well playing that game. And for me, that's really exciting. And we are finding that this space is providing this market gap that has existed. It's providing new forms of capital to help founders who aren't just gunning for the $1 billion idea when they've done no executing to do.
And it reduces the risk of failure in some aspects, right? When you're investing in these more mature companies that have been around for the past 5 years, that have seen revenue growth, that are profitable, and you can still invest in them with significantly lower valuation than they would be if they're trying to go the VC route. But you also know they're going to continue to grow because clearly they have a good operator in charge. Clearly they understand their product, their audience, and their company. And yeah, I think that's really exciting too. You know, the opportunity to invest in all sorts of companies, right? You don't have to stick to one industry either. You can go to all sorts of industries. And yeah, there's a lot of excitement. There's a lot of things that get me excited about this opportunity. And on that note, what excites you the most when you look into 2024, 2025 in equity crowdfunding?
So I think when I look at the industry, I think we're hitting an inflection point where we're maturing as a space. And we're starting to see that like we kind of know the bottom of this thing isn't going to fall out, which for, many years, I think many of us kind of wondered where this thing was going to go. But we're now at a place where we're really well established and we're starting to see those institutional players get involved. So I'll give you an example. Public.com, which is kind of like a Robinhood. You could go and sign up for their brokerage account. They've actually made a pretty big investment to invest in enabling folks to be able to invest in alternatives. So they actually did an offering where you could invest in the movie rights of Shrek. That's actually returning pretty good, like,
Really?
I think 10+%. And they're going to be doing more movie right investment opportunities, which I think is so cool. And SoFi just put out an ad recently saying that they're going to start offering real estate and other types of alternatives directly on their platform. That's the type of stuff that we start to need to see if we're going to really see the industry step up and take that next step. For me, that's kind of the first sign of where things are going. The other thing that I think is really cool is that we're starting to see more of the platforms offer the secondary liquidity, as you mentioned. So whether that's through the Republic note that's trading on INX, whether that's the Start Engine marketplace, Republic has kind of a small marketplace available. Nick Capital is working with a group called Templum to make secondary trading available. We're seeing more and more liquidity solutions be built. And I do think now we're in that time frame of like 1 to 3 years until we really start to see velocity in that space. And again, I think that's just going to bring more investors in and also enable people to continuously reinvest, which is pretty cool.
Then what is your vision for KingsCrowd looking at a 5 to 10 year vision?
We always talk about we want to own the world's private market data. From my perspective, right, just in the United States alone, there's over $13 trillion in assets that sit offline. And what does that represent, right? That's single family homes. That's apartment buildings. That's commercial real estate, including all the malls that you go to. That's including all of the offices that you might work in. That includes all of the debt that's out there, whether it's, your consumer debt loans, whether that's business debt loans. That includes all the startup equity. It's everything, right? Massive market that has historically lived offline. People signing papers with pens and sending things in the mail, sending wires, lots of costs, lots of lawyers involved, right? Just horrible processes. Now, it is our belief that world doesn't live offline for the rest of the time.
Yeah.
My vision is that those 13 trillion in assets, even if it's not 100%, we see 30, 40, 50% plus private market assets in the United States digitally available to invest in online with more publicly available data than has ever been available before. It is our opportunity and our goal to own the data across that entire spectrum of investment opportunities. And then to do that on a global scale, UK, LATAM, and eventually APAC. When you think about that opportunity, if you just look at Bloomberg and S&P in the public markets, those two companies collectively are worth over $200 billion. $200 billion. All they do is provide data on public equities on a global scale, public equities and bonds, right? That is actually, in fact, a smaller market than what this market can be by an order of magnitude if we see any sort of adoption in the way that we expect. So if, and that's a big if, but if that thesis plays out, we have an opportunity to be one of the world's largest data companies that's ever been built. And that's what I'm striving for. That's what our team's striving for. It is an incredibly ambitious goal. And all I want to say is we are not anywhere near that. We're practically day one, 6 years in, just to be clear. But we are far more along than we were on day zero when I started this company about 6 years ago.
Well, where can I invest?
Great question. Maybe the most important question on this podcast, Connor. You can actually go to WeFunder. I believe it's wefunder.com/KingsCrowd, and you have an opportunity to invest and join the journey. And again, I just want to be really clear. It's going to be a long ride, but it's going to be an exceptional one from my perspective. And I'm really looking forward to the future.
Data is only becoming more and more important, especially looking into the future. I mean, the world right now already runs on data. I can only imagine what it's going to look like 5 years from now. Data is going to become the pinnacle for making any single important decision. So that's fascinating. A couple quick questions left before we started. I mentioned the books I see in the bottom right corner of your screen. So what's the most influential book that you have read that's really shaped how you act and operate as a founder?
Man, it's a tough question. Over the past 6 years, alongside building this business, I've kind of tried to give myself an MBA by just reading every possible book I could about business founders, politicians, sports folks, anyone who's had great success, right? Like, what can I glean from them? But I will mention a story that I read recently, and I'm just going to look behind me. The book is called Made from Scratch by Kent Taylor. Kent Taylor was the founder of Texas Roadhouse. One of the interesting things I think as a tech entrepreneur is to not study other tech entrepreneurs, right? There's kind of the playbook of things to do when you're a tech entrepreneur, and they talk about capital raising, this, that, and the other thing. But if you really want to learn about being a creative strategist and a builder of business, I highly urge you to read books outside of the tech landscape. So, I don't know if you've ever been to a Texas Roadhouse restaurant, but Kent Taylor found an inefficiency in the market of steakhouses and said, I can do something better. And he's just an incredibly creative, thoughtful, kind of zany, wild founder. And if I've learned anything over the past many years, it's that kind of these maverick spirits who think beyond what all of the incumbents are doing, right? He saw where Outback and all these other restaurants were going wrong and decided there was an opportunity to capitalize on that and build something that people would really love. And then he spent all his time listening to those folks to figure out exactly what it is that his customers wanted. And they've had outrageous success. I mean, they're worth billions and billions of dollars. They've paid, hundreds of millions or billions of dollars in dividends. The company has done so exceptionally well during COVID. They did some amazing pivots to manage their business and were able to pay all of their employees and take care of everyone in the worst of times. I mean, this is a really creative, thoughtful guy. And it's folks like him where I get those new, creative, thoughtful ideas about how to build my business, how to approach doing things differently. When you do things differently and you do them in a unique way, that's what's going to separate you from the pack, right? Just reading another tech book, it's pretty homogenous at this point. Yep. So for me, I look for those different ideas, perspectives, and viewpoints from different industries. And it really energizes me. And I absolutely love the book. And frankly, it's a fun read.
Did the founder come from the restaurant industry?
He ended up getting into the restaurant industry. Yeah, he actually worked at a pretty much failed restaurant group called Bennigan's, which was like an Irish pub style chain. And he saw all the issues they were having, and he was one of their top performers. And the leaders of the organization actually didn't like him because he was bringing far too many new ideas to the table that made him uncomfortable. So they stuck him out in Denver, Colorado and said, manage this absolutely terribly managed restaurant and stay away from our headquarters. And eventually he was able to piece together the money to go do his own thing because he was just tired of dealing with that bureaucracy.
That's awesome. And then last question, what advice would you give your 22-year-old self?
The journey of building a business, a really successful, sustainable business that will be known for a very long time, that will have really long longevity and be around for a long time, requires just immense patience and years and years and years of investment and time and effort and just showing up day in and day out consistently for years on end. Any of the successes you hear about, almost all of them are 10, 15, 20 years in the making, right? Uber just turned a profit. I think they're like 15 or 20 years old. Like it took them almost 20 years to be a profitable company for the first time. So I just want to say that the journey is incredibly long. The greatest asset you have when you're 22 is that you're incredibly young and you have all the time in the world and you haven't built your life in a structure where it's really hard to not make a lot of money for a while. So frankly, from my perspective, the younger you can start, and some people would argue you should go and work for someone who knows more than you and learn from them. And that's a great strategy. But from my perspective, I would say start as young as you can, put yourself out there, be vulnerable, fail if you need to. And that's very much a part of this process, 100%. But get out there really, really early and just start getting after it because it's going to take you years and years and years. And if you start in your 30s, 40s, or 50s, man, is that going to be a tough ride. So I think start as young as you can. Don't be scared to take that leap and recognize that once you do take the leap, it's going to be incredibly scary, but that's okay.
A 20-year overnight success story, right? That's the...
That's right. The old adage.
Yeah. Well, Chris, thanks for coming on. I really appreciate it. And you are raising on WeFunder right now?
That's correct. Yep.
Everyone go check them out on WeFunder. And as always, thank you for listening and see you next time. Bye-bye.